Morning. Top Gun here, Saturday, February 13th, a little after 4 a.m. Pacific Standard Time. This is going to function as the YouTube pre-market commentary for Tuesday, February 16th. All right, the weekend review. Another good week for stocks with the S&P up 1.23%, the NASDAQ 1.72%, and the Russell 2.97%, all to new all-time closing highs. The most interesting action last week was in the marijuana stocks, and you can see this by looking at the main marijuana ETF. The ticker is MJ, which was up 42% Monday through Wednesday, and then dropped 26% on Thursday and Friday. So a lot of volatility, like we've seen with Tesla, GameStop, Bitcoin. A lot of speculation going on. Now, the most interesting market commentary I heard was from Josh Brown on CNBC's Closing Bell Wednesday afternoon, where he said that valuation is junk science because it provides no signal in terms of which way stocks are going to go. So basically what he's saying is, look, stocks have been expensive for years and they continue to go up. So what use is valuation to me as an investor? So he says, you throw your dart, I'll throw mine to the people that are taking valuation into consideration. Now, the problem is, how do we make decisions without incorporating valuation? So Josh talks about how the market has correctly priced some of the leading growth stocks. He mentioned Salesforce, Netflix, and Tesla as three examples. And he also said that liquidity has been a much more important factor than valuation. Now that's correct. Liquidity is what's driving this market, not fundamentals. However, if you combine the two together, it seems to be Josh seems to be suggesting that we just buy the leading stocks in a backdrop of good liquidity, and we just hold them forever, and we buy them regardless of price. And we hold them regardless of price. And, that has been tried once before in the early 70s with the Nifty 50, which were considered one decision stocks. You just buy them and forget them. Price doesn't matter. And that ended badly in the 1973-1974 bear market. And this type of philosophy will end badly this time as well. The price action is also getting the kitty technicians pretty worked up as well, with J.C. Perret and Ian McMillan both saying that we're closer to the beginning than the end of this new bull market as they see it. Now, one of the things that I've been talking about is that all this liquidity injections by global central banks is going to have secondary effects. So far, the first order effect is to drive up the financial assets that the Fed is injecting money into. So it's injecting money into the bond markets, into the mortgage-backed security markets, and then people who are selling those securities to the Fed are then taking that cash and investing it in stocks. And one of the second order effects that we're now seeing is rising interest rates. The yield on the 10-year Treasury has risen from just above 0.5% in early August of 2020 to 1.2% on Friday. So you can see that in the chart in my blog. Big rise in interest rates. Now, Ned Davis research strategist Tim Hayes has something interesting to say about this in this week's the trader column in Barron's, where he said, so far the correlation between bond yields and stocks has been positive. However, if the correlation, this is quoting Tim Hayes, if the correlation would return to inversion, it would tell us that the market has started to view rising yields as a threat to economic growth and in turn corporate profits. Right? So we're in a highly indebted society. Governments, corporations, individuals are carrying a tremendous amount of debt. So there's a certain point where rising interest rates start to squeeze us and start to eat up more of our discretionary income or corporate profits, squeezing margins, or government budgets. And that level is probably not 1.2% on the 10-year, but if it's rising this fast, there is going to be a level where that's a problem. And already 0.7% does make a difference in terms of your interest expense. Another area we're seeing these liquidity injections spill over into is commodity prices. You can see that in the chart of copper prices and copper futures and lumber futures by Ian Culley and Tarek Saab. Lastly, the VIX, the fear index, closed below 20 on Friday, 19.97 just barely, but for the first time since February 21st, 2020. It's been above 20 for almost a full year. And so what it says is investors finally are starting to kind of get comfortable with this market and not feel any need to buy puts, buy insurance, and they're just becoming more and more comfortable and complacent, which to me is another warning signal. So to sum up, what's driving this market is massive global central bank liquidity infusions. You can see this in the chart. I've included showing the growth in central bank assets from the ECB, the Bank of Japan, and the Fed, which have just exploded since the pandemic. It's inflating a massive stock market bubble, and it's now percolating into other areas like interest rates and commodities. This is not real economic growth. And I linked to a piece on what real economic growth is in the blog. So right now, all these liquidity injections have created, a mass psychological mania, and the market won't break until something causes that psychology to break. Now it will break. We just don't know when. All right, I will see you guys on Wednesday, February 17th. Have a great President's Day weekend.